Hello everyone, Dave Alison, co-chair of the investment committee at Prosperity Capital Advisors, and I am happy to be with you here today talking about our fourth quarter market intel report. Certainly a lot going on in markets. We just came off of what I would call a little bit of a spooky September. We had our first pullback after the markets really ripped through the first half of the year. But there's a lot going on, and what we're going to talk about in this video are really the three key themes that are on the minds of investors today, things that we're hearing about frequently. The first being, why hasn't this higher interest rate cycle caused the economy to slow down more? Then we'll spend a little bit of time talking about what might come next for interest rates. And then third, last but not least, we'll talk about, is it a good time to consider adding fixed income to your portfolio? So this first key theme that we're going to talk about today, the big question out there, why hasn't higher interest rates caused the economy to slow down more? We've seen a historic Federal Reserve interest rate increase trying to combat and fight inflation. One of the tools that they use to do that is increasing interest rates, which should encourage people to save more, spend less, cool down company earnings, cool down prices out there. But we really, although we've seen inflation come down, we really haven't seen the economy cool too much. And part of the reason for that is if we look at some of this data, I've mentioned in some of our previous videos that the one positive that we had of keeping the economy hot is that corporate balance sheets are very healthy. The amount of cash and the debt that they have is not leading us to believe, at least for the biggest companies in the United States, that there's a lot to worry about. And part of this was some of the decisions that were made throughout the pandemic. So for example, on the corporate side, down at the bottom on this chart, you can see that over 50% of the S&P 500 companies, these are the 500 largest companies in the United States, had done a good job managing and refinancing their debt when we had historically low interest rates during the pandemic. And in fact, 50% of the total debt of all of those companies is not going to mature till after 2023. So this means their interest payment and their debt servicing is going to stay fairly low, at least for the next 6 years. If we flip over to the retail side, the consumer side, we saw the same thing in the housing market. You see, these higher interest rates, although they certainly would impact a new borrower today looking to go buy a home, they're not really impacting in real time those of us who locked in a very low interest rate during the pandemic when we saw historic lows. And in fact, we see in the data, 61% of outstanding mortgages have an interest rate below 4%. And so again, that's keeping the borrowing cost down, which is allowing people to have more discretionary spending to still go out there and buy things, power the economy, drive company earnings. Now, again, some things to keep an eye on is, of course, real estate prices. I mentioned earlier, for those of us that are in our homes already and we've got these low mortgage rates locked in, it doesn't really impact us. But somebody purchasing a new house certainly has a harder time financing and taking out a mortgage. And this is why you start to hear a lot about the fact that real estate prices will have to come down at some point as long as interest rates stay high. The other thing to take into account here is any balloon payments or adjustable rate mortgages and what happens to those payments when those mortgages come out of their low fixed interest rate and might adjust to a higher rate. So again, the big question on why haven't higher rates caused the economy to slow is the majority of the debt out there isn't being subject to these new higher rates, both on the corporate side and the consumer side. Now, some things that we're keeping a close eye on as well as the labor market. We've spoke about this in other videos, and overall, the labor market continues to remain quite strong, but we are starting to see some job growth is slowing. In fact, over the last couple months, a couple of the reports that came out actually showed monthly change in U.S. non-farming payroll jobs actually fell below the long-term average, or at least the pre-pandemic average, for the first time since we came out of the global pandemic. And so at this point, it's nothing to really ring an alarm about, but it's definitely a statistic or a data point we'll want to keep an eye on, because again, I've shared in many of these videos, as long as we have a strong labor market, we should have a sustainable economy. But when that labor market starts to teeter, right? When people start to lose their job, we certainly know that's a leading indicator of a potentially challenging economic environment ahead. The other thing that we're keeping a close eye on is credit card delinquencies. And so what we're starting to see, and you can see it in the bottom part of this chart here, is we're starting to see credit card delinquencies tick up since the pre-pandemic levels. Now, what we saw is all the government stimulus that got passed out during the pandemic elevated people's savings rates. They had a bunch of cash on hand. They were out there spending it. They were paying off their credit cards as they were racking up credit card expenses. But we're starting to see now, for the first time since post-pandemic, that individual savings rates is declining. A lot of that stimulus is pretty much depleted, and now we're starting to see a tick upward in credit card delinquencies. And so that's another thing to keep an eye on, because again, if consumers aren't out there aggressively spending, it might create a slowdown in economic growth. On top of that, we're also starting to see things like student loan repayment resuming this month. And so these are all things that essentially take away from the U.S. consumer's ability to go spend more money, because if part of their paycheck is going to pay off student loan debt, or pay a higher interest rate on their credit card debt, or pay a higher interest rate on their mortgage, that's less that they can go spend on some of the goods and services that drive corporate earnings. Now, when we look at kind of where things are headed and tying into this second key theme, we know that, or at least we have a reasonable belief to think that the interest rate hikes are behind us for the most part. The market and the Fed are kind of debating back and forth on potentially one more interest rate hike. We've seen it anywhere from 25 basis points to 50 basis points. And really, it just depends on how we continue to see the numbers and the data come out about inflation and job growth. Because although we want to continue to battle inflation, the Fed has marching orders to try to not tailspin us into a recession. And so far, the progress on inflation supports the Federal Reserve pausing interest rate hikes. And so what we've seen in some of the numbers is headline inflation is now around 3.7%. We had a slight tip upward from a year ago to today, but most of that high inflation that we experienced during the pandemic has come down. A couple of the key components is shelter. Shelter tends to be a very sticky component of inflation. And when I say sticky, I mean it tends to take a long time to bring shelter down because, think about rent out there. Most people rent an apartment within a 1-year agreement. And so most landlords aren't going to lower rent within the agreement that they have. But when that agreement expires and they need to sign a new lease agreement, they might need to lower rent to be more competitive based on the reduced levels of inflation. We're also seeing core CPI data, which is really kind of the Fed's target, continue to come down. And in the latest readings, we're seeing positive movement in that. But for the most part, I think while most of us think that the rate hikes are mostly behind us, the market has an expectation that interest rates are going to remain elevated for an extended period of time. We're starting to see some of the consensus is that the Fed might start cutting rates towards the end of 2024. But the reality of it is, if the economy continues to remain resilient, the Fed is not going to be in any hurry to lower interest rates. And so, again, this is just something to keep an eye on how these higher rates for longer might impact the overall economy. I mentioned earlier the biggest of the companies, the very high quality companies, at least in the US, seem to have the balance sheets to be able to weather. They have record amounts of cash. They refinanced a lot of their debt. They're not going to have to go out and take out new loans or issue new bonds at these higher rates. But it will be interesting to see how this impacts smaller companies, companies that maybe didn't have the capital structure or the advantage to refinance in low rates, or smaller companies who need to get new funding at these higher interest rates to continue to grow. And so we're going to continue to keep our eye on different parts of the stock market and how it impacts different companies. And last but not least, as we land the airplane on our Q4 market intel report, I want to talk about the addition of fixed income into a portfolio, because some of you might be looking at adding more stability to your portfolio. And in a traditional market, fixed income provides that ballast or that part of stability as opposed to, for example, equities. Now, we know and we've seen over the last 2 years that as interest rates rise, your fixed income can fall. In fact, in 2022, it was one of the worst years for the fixed income or the bond market. And so far this year, because we've seen interest rates rise a little bit more this year, we've seen bond values fall. But at some point, if we believe we're nearing the top of this interest rate cycle, it could actually bode to a favorable outlook for bonds. Because if we do see interest rates start to fall, that could equate out to capital appreciation or gains in bonds, because again, as interest rates fall, bond values increase. And so for those of you who might have money in cash or might want to reduce overall exposure or volatility to stocks, bonds could have a very favorable outlook in your portfolio right now. Not only do you get a high cash flow via the yields that bonds are paying right now, but you also have that double kicker of capital appreciation if we do start to see the economy get dicey and the Federal Reserve decides to start lowering interest rates to prop up or support the economy. That could equal a positive price increase for bonds. And this chart just shows what that impact could be. So for example, if we saw a 1% decrease in interest rates, that would equate out to about a 10.5 to an 11.5% return for bonds. For example, with the US aggregate bond index, if we see the Federal Reserve decrease interest rates by 1%, that could mean capital appreciation of about 11% in US aggregate bonds. You could see the next column over, investment grade corporate bonds, a 1% decrease in interest rates mean about an 11.87% capital appreciation on top of the income that you're generating. And then US Treasuries, a little bit less risk than, of course, the aggregate index or corporate bonds. A 1% decrease means almost a 10% increase in capital appreciation. And so, although there's always uncertainty in the economy, There's always an outlook to align your investments with your risk tolerance, your volatility, your income and cash flow needs, and your overall financial plan. So again, we've got a close eye on these 3 key themes. If you have any questions at all, please don't hesitate. Reach out to our team, reach out to your advisor. We're here to help. Thanks a lot, and we'll see you next quarter.